Hi everyone, welcome to the Buffett and Beyond Research Saturday ETF report, and this is August 10th, 2024. And remember folks, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let us look at the QQQs. This is the NASDAQ 100, and what we do at Buffett and Beyond is we use a methodology called Clean Surplus, which allows us to compare stocks and compare their growth and their efficiency. And we take the best stocks out of the ETFs that fit our criteria, and that's how we pick the best stocks in the QQQs. So here's the QQQs, and we're going to see the results of that portfolio a few slides from now. But let's look at the QQQs and see what they're doing. We got a little buy signal in here finally, and this is as the close of Thursday, and I'm recording this on Friday, and we're up even more on Friday. So we got this buy signal in here on Thursday because of the nice rally that we had, and you can see it right up here. And down here we can see that this red line is the 200-day moving average of the QQQs, and the NASDAQ shows the same type of chart exactly. And we had this market go down below that red line. I know it's hard to see it with the volume bars down here, which are the vertical bars, but the market went down, the QQQs went down below that 200-day moving average and then closed above it right at this point, and ever since then has been climbing ever so slightly. Little rough in here on Wednesday, but then Thursday it came roaring back, and we can see down here that it looks like this indicator wants to turn up. Of course, it fooled us right in here where it started to turn up, and we thought that was it. But then it had another leg down, and it's these 3 down days, which was pretty ferocious. So we have to be careful. But if this black line turns around, crosses over this red line, that's an all-out buy signal, and we're good for 3-4 weeks, maybe more. And when we look at the SQQs, because the SQQs are the inverse of the QQQs. And what some of the platforms with some of the brokerage companies allow you to look at the reverse of a stock. So the SQQQs right here move inverse to the QQQs, which I'm going to right now. So as the QQQs are starting to rise, the SQQQs, this one, should be starting to fall. And that's what we're seeing. We see this downward divergence here, or bearish divergence, which means the SQQQs are now going down while the QQQs go up. And we can see this downward movement in here, and this almost touched the 200-day moving average. So we're doing pretty good in here. But the big thing is that right in here we can see it trying to turn over. Of course, again, we were fooled back in here, but if it does cross over this line, and it'll take a couple of days of good market action, which means the SQQs are going to go down, this will turn over. All right, let's look at the technology XLK ETF that we use, and we can see it is sitting around its 200-day moving average, and we have this little buy signal in here, and it looks like this wants to turn up because we're very oversold in here. So we'll see. We just might have a rally coming up here, folks. Let's look at the semiconductors. We see the same thing, except the semiconductors are very weak, fell below the 200-day moving average in here, and now it's starting to gain a little traction to go back up. We don't have a clear buy signal up here like we did on, well, let me show you, on the XLK. You see this is a nice little short-term buy signal in here. We don't have that on the XSD, which is a semiconductor, but it fits that it could go up, and it did go up. And let's look at the housing sector, because we're always interested in the housing sector. And we would think with interest rates coming down, we would get a buy signal in here. We did get a slight buy signal in here. So the housing stocks should be perking up, and that's going to be good for our overall 30 stock growth portfolio. And then we looked at the XLE, which was energy sector last week, and it's starting to go. And the only reason I follow the energy sector is because some of you like to invest in energy. I particularly don't, because there's too many exogenous factors out there, like government intervention in various countries, cutting down the oil supply, increasing the oil supply. So we don't get involved in that too much because there's just too much guessing going on. But it is starting to catch a bid in here, as they say in the market. Catching a bid means we're starting to go up here a little bit. And then when we look at the utilities had a nice run in here as interest rates were coming down. And now all of a sudden, now that the market is thinking that we won't have a bad recession, because this is why interest rates came down, because people were taking money out of stocks and putting them into bonds and utility stocks, when we have the scare of that we're going to go into a recession. And then the past couple of days that has been betting, and we are seeing this ETF start to level out in here. And let's look at consumer staples. Some of you were interested in that last week, and we could see that we were pretty steady in here. And then all of a sudden, as a defensive measure, people moved into the consumer staples. But how long it will last, we don't know. So we don't even look at this. But a lot of you do, because you like the stocks. And this is the stocks that we had in last week's video. And you can see Procter & Gamble, Costco, Walmart, Coke, Philip Morris, Pepsi, Mondelez, Altria, Colgate-Palmolive, Target. But we can see that over 5 years. Now, this is the chart from last week. So look close. Here's the S&P 500, the black line. And we can see that the XLP, which is the consumer staples, is right above 30%. This is over 5 years now. And the XLU, the utilities, is below that. Now, let's look at the chart from this week. And we can see not any difference, do we? Except the S&P 500 came down a little bit more, but these two did not move. So if we can outperform the S&P 500, then we belong in the S&P 500 and not the other individual stocks. So the XLU does pay about a 3.2% dividend, and that's why some people get into it. But you can find utility stocks that pay more than that, of course, but they're a little bit more risky. So let's go to the sector stars, and these are the portfolios or the top stocks in several of the portfolios, like some of the QQQs, like the semiconductor, like the technology, and a few from the housing are going in there. And last week we were up 15.3%. This week, even though the week is down as I'm recording this, we were up because some of the money is starting to come back into those growth stocks. If we were hedging, and hedging means if we're timing the hedges, we use 10% of the portfolio value and hedge 30% of the portfolio. That's because the SQQQ is a 3-for-1. So as the market moves, as the QQQs move up, the SQQQs move down 3 times as fast. So in this case, when we think the market's going down, we will buy the SQQQs, and when we think the market's going to go back up, we'll get rid of the SQQQs and buy the QQQs for the upward ride. So far this year, we're up 5.8%. And when you look at that, last year, or last week, we were up 15.3%, but with the money we made from hedging, we were actually up around 20%. This week, we're up 18.6%. We got rid of our hedges, and with hedging and then getting into the either stocks or the QQQs, we're up 22.5%. But the portfolio itself is up 18.6%. We gained 3.3% this past week, which is nice. S&P stayed right around the same, and the QQQs itself stayed right about the same. So it helps, in other words, to pick the better stocks in the ETFs works out better than just buying the ETF itself. So if we bought the QQQ ETF, we'd be up 9.4%. But because we're buying the best stocks in the 3 or 4 ETFs that are our favorites, we're up double the QQQs. Very, very nice return. And folks, this shows up every year that we outperform the ETF itself. Very few times do we not outperform the ETF when we pick the best stocks in the ETF, and it just makes sense. Pick the best stocks in the ETF, you're going to outperform the ETF. And let's go to the QQQs alone. And again, as I mentioned, the QQQs up 9.4%, S&P up 11.5%. And if you just bought the top stocks, that 11 stocks that we have in the QQQs, we're up 23%. So we're doubling, more than doubling the S&P, more than doubling the QQQs themselves. So it goes to show, picking the best stocks in the QQQs will get you a better return. So we're up about 3%, actually 2.9% from last week. And if we include the hedging, we're up about 28%. So the hedges, if you time them right, will add value to your portfolio. And then on the way down, if we're trending down as we have been the past 3 weeks or so until just recently, then you can slow down the decay of your portfolio because you have the hedges in there, which are hedging about 30% of the portfolio, which is nice. It's a little insurance, and it takes timing to do that, but we can do it, and we can see that it's performing very, very nice in here. So without the hedging, we're up 23.5%, which is great, folks. And then if you're using hedging where we can make some money out of it, especially after this decline, we're up 28.6%. Very, very nice. So, folks, we had a tumultuous week. There's that word again. And it looks like the week will be down, even though we had that great rally on Thursday. And, of course, the market is not closed yet, so we're not sure. But our portfolios went up during a week when the market is going to close down for the week. And this is what, the fourth week in a row here. So we should be bottoming out here for a little while. So, folks, crazy week. Go out this weekend. Forget about the market. Be safe. Have Sunday dinner with your family. Go out, clear your head. We'll be back here on Tuesday. So you folks go out. Stay safe. We'll see you in a couple of days.